Good afternoon, ladies and gentlemen. Welcome back to this week weekly market review. Today is 1st of April, April's Fool's Day, but we are down to serious stuff. I hope everyone have a good rest over the Good Friday long weekend. I'm sure Gerald had a good rest also. How are you, Gerald?
Yeah, so it was a very welcome break since the first quarter of the year was very busy. Shortly after we went into the new year, celebrated Chinese New Year, then before we realized the first quarter is over already. So good to actually have the breather before we go into the second quarter of the year.
Yes, indeed. So first quarter of this year passed so fast, right? And I believe today you will give us a bit of a roundup of what happened in the first quarter and how we can look forward to the next quarter.
Yep, definitely. Okay, so as usual, today's session is for information purposes only and should not be taken to be advice in any way. Okay, wanted to flag that we are doing the SIAS session on 17th of April. This is something that is open to all participants. So if you have got any questions for Sunny and myself, do go to this website, scan the QR code, and register your participation for the upcoming SIAS on 17th of April. If you find the session helpful, do leave us a review on Google. And do consider joining SIAS as a member, which costs $12 per year or only $1 per month. Okay, so we are now into the second quarter of the year. What we saw for the last week of March is that the US market continued to do well. So the S&P 500 actually ending the quarter on a positive note at 5,254 level. Okay. But what we are starting to see is a bit of divergence between the indices, in which the Dow Jones actually did better, while some of the tech stocks actually had a moderate correction. Okay. The Singapore market continues to trade sideways, okay, at about the 3,200 levels. And we will see what are some of the top gainers and losers amongst the STI later. Okay, so if you were to look at what has really happened in the first quarter, generally I would describe it as a quarter where the interest rates have been very volatile. Okay, while the general expectation is for more rate cuts in 2024, what we see is that depending on various economic data, depending on what the Fed message is, there were periods of time when we saw sharp movements in the US government bond yield. So if I were to look at the end of 2023, we were at about 3.9% for the 10-year US government bond. Okay, it recovered slightly as the expectations of the rate cut became more moderated. And then it came back down to below 4% again when investors thought that, okay, the Fed might actually continue on its rate cut path. But overall, what we see in the first quarter is that there has been a gradual increase in the 10-year US government bond yield, now back to about 4.2%. Okay, so what has really happened is that maybe the market was too aggressive in expecting this rate cuts towards the end of last year, and we have seen some reset of expectations around that. Okay, so at this point in time, the first rate cut is still expected in June this year. So if I were to look at the expectations of the upcoming June meeting, based on the CME FedWatch tool, there's now a larger than 60% probability that we'll start to see the first rate cut in June this year. Okay, so as we approach the second quarter, now that we are in April, this is definitely something that we'll keep a very close lookout for, because after close to 2 years of a rate hike cycle, this might be actually the quarter that we'll start to see the Fed starting to cut interest rates. Okay, if I were to look closer to home, the T-bill is something that many investors have been interested in. We get a lot of questions on that as well. And if we were to look at the cutoff yield on the T-bill, what surprised us is that it has actually remained fairly resilient. In the latest auction, it was still at about 3.8% for the 6-month Singapore T-bill. So if I were to compare that to where it was in the past, at a fairly high level, even though it's come off just slightly from the peak of above 4%. Okay, so what once again we are looking out for is when the Fed actually starts to cut interest rates, whether we will start to see a decline in the cut-off yield of the T-bill, which so far for the first quarter has been at a fairly high level. Okay, so going into the market, what we see here for different top performers of the STI, we have got SETS, Yangzijiang Shipbuilding, Semcom Industries, so quite a number of industrial stocks. Then we have got Mapletree Industrial Trust as well as Wilmar International. Okay, in terms of the worst performers, we see quite a number of the property developers here. So City Developments, UL, CapitaLand Invest, as well as Hong Kong Land, probably due to concerns around whether the interest rate environment that we are in now, which still remains fairly elevated, will actually impact the demand for some of the new property launches. Okay, so we saw earlier that Mapletree Industrial Trust was one of the top performers of the STI. I think as the expectation around the US Fed rate cut becomes more elevated, we get more and more questions around the Singapore REITs, and particularly some of the blue chip REIT names like Mapletree Logistics Trust and Mapletree Industrial Trust have been names that we get a lot of questions on. So what I wanted to go through today is just do a quick comparison between Mapletree Logistics Trust and Mapletree Industrial Trust, since we commonly get the question around like, oh, what is the difference between the two, and how do I think about then comparing REITs that I might be considering, okay? So I think first and foremost, we see that actually while they both have Mapletree as a sponsor, while both of them are within the industrial REIT segment, there's been a fair degree of divergence in their share price performance. So what we see here for Mapletree Logistics Trust is that actually the share price performance has been fairly weak so far this year. From above 170, it came down to close to 140 at a point in time, before recovering now slightly to 146. Okay, so actually it is at one point actually lower than where it was in the October 2023 lows, and hence people are wondering, oh, how come the share price of MLT has been so weak? On the other hand, what we see for Mapletree Industrial Trust is that it has been a bit more resilient. Okay, especially when I look at it from a one-year trend perspective. Yes, it has come off slightly from where it was at the start of the year, but the decline is definitely not so significant because it is from about 250 per share to about 234 per share. Okay, and if I were to look at it over the past 1 year, effectively it has remained about flat. Okay, so first and foremost, we need to then understand, okay, what is the difference between MLT and Mapletree Industrial Trust? If I were to look first at the assets of Mapletree Industrial Trust, I think the first thing to take note of is that the exposure is very much just to 3 markets, of which 2 of them are more predominant. One of it is North America, which is about half of their total assets, and then the other one is Singapore, which is also about half of their total assets. Okay, Japan is a small exposure at about 4%. So that is one factor that I would think about when trying to understand the difference between Mapletree Industrial Trust and Mapletree Logistics Trust. The other key point to take note of here is if I were to look at the breakdown of the different assets, okay, Mapletree Industrial Trust has got 142 properties across 6 segments, but data center would be the largest segment, now representing about 56% of its total portfolio. Okay, so that is something that I would actually bear in mind when thinking about whether or not I would prefer the exposure of Mapletree Industrial Trust versus Mapletree Logistics Trust. Okay, on the other hand, if we were to look at Mapletree Logistics Trust, what we see here is that the exposure is much broader. Okay, so you've got Singapore, Hong Kong, China, Japan, South Korea, Australia, Malaysia, Vietnam, but none of this actually contribute close to half of the REIT's exposure. In fact, you've got 4 markets, Singapore, Hong Kong, China, and Japan, which makes up about 10 to 20% each of the total assets. Okay, so definitely in terms of the exposure across different markets, what we see for MLT is way more diversified compared to what we see for Mapletree Industrial Trust. Okay, so this is a summary of the comparison of the portfolio composition. We saw that MLT has got more assets compared to Mint in terms of the number of properties. In terms of the number of countries, MLT is exposed to 8 countries, while for Mapletree Industrial Trust, it'll be 2 key markets, including US and Singapore, and a smaller exposure to Japan. Okay, and if I were to look at the assets under management, Mapletree Logistics Trust would be just slightly bigger at about 13 billion Sing dollars. Okay, next, we can look at the operating metrics. If I were to look at the occupancy rate of Mapletree Logistics Trust, it is at about 96%, slightly higher than what we see for Mapletree Industrial Trust, which is at 92.6%. But if you were to compare the rental reversion, then it tells a different story, where for Mapletree Industrial Trust, they've been able to get a stronger rent reversion of about 7%, while for MLT, it is at 3.8%. Okay, so depending on whether the occupancy rate is something that's more important to you, or the rental reversion rate is actually something that's more important, then effectively you would come across different conclusions by looking at the operating metrics of MLT versus Mapletree Industrial Trust. Okay, in terms of the debt profile, quite similar gearing ratio, both below 40%, MLT at 38.8% and Mint at 38.6%. Okay, but what is interesting to me is that the weighted average cost of debt is lower for MLT at about 2.5%, while for Mapletree Industrial Trust is at 3.1%. The good thing is that both of them have fixed a significant amount of their debt on fixed rates. So what this means is that even if the interest rates were to go up further, the impact to their cost of borrowing might be fairly limited. Okay, next we look at the financial performance of the 2 REITs. This is where the trend becomes a lot more interesting. Okay, so the good thing is while quite a number of REITs face headwinds in the past year, both of them have been fairly resilient both across their net property income as well as their distributions. Okay, the revenue on a year-on-year basis for the quarter ending, for the 9 months ending 31st December, was a slight increase for both of them. Net property income, slight decrease for MLT, but about flat for Mint. But if I were to look at the DPU year-on-year change, what we see is that MLT was able to get a slight increase, but for Mint, we saw that it came down by 2%. Okay, so overall, not that much of a difference. I would say across all the REITs that are listed on the Singapore Exchange, both MLT and Mint have been able to show that the distributions have been fairly resilient, especially given the sharp increase in financing costs that we have seen impacting quite a number of REITs. So to bring it all together, if we're to look at the distribution yield, given that MLT share price has come off quite sharply over the past 3 months, and that they have actually been able to keep the distributions at a fairly stable level, we are now looking at a dividend yield of about 6% for MLT, which is higher than what we have for Mint, which is at about 5.7%. Okay, so hopefully through going through some of the key metrics, the balance sheet as well as the distribution, we'll be able to get an idea of how we can compare different REITs and find out which is the better one that might fit within our portfolio. Okay, in terms of what to look out for ahead, it is a fairly quiet week as we start the second quarter. We have got a number of ETFs and stocks that are going ex-dividend. I think the one that many people are looking out for is the DBS ex-dividend, which is on this Friday, 5th of April. In terms of the macro data, we will have the US non-farm payroll data that's coming up on Friday. So that will effectively set the tone for the second quarter and help us understand whether the Fed is still on track for the first rate cut in June this year. So with that, I will hand over to Sunny, who will share with us how the technical indicators are looking like.
Okay, thanks Gerald for that coverage on Mapletree. I think that's very useful. And Gerald also talked about the non-farm payroll that's coming up this Friday. So I just want to give everyone a heads up first before the data come out this Friday. We are looking at non-farm payroll numbers coming in slightly lower. The consensus is 200,000. The previous one is a 275,000. We expect unemployment rates to stay as per before. So these are data that I keep a close watch on because we have lined up, we have talked about it earlier last week that we are all lined up that we are looking forward to 3 rate cuts to the total of a 75 basis point. So we want the data to be more or less in line with what is expected. If there's any deviation from the actual data deviates from the consensus or the previous numbers, that may be something that of a concern that the outlook might change. Okay, so this is what we will be looking out for this week on Friday. Next, let me look at the index performance and do a roundup of what happened in the major index. I'll start off with the STI index. So key thing to note here, STI index actually had a new year-to-date high on last Wednesday where it hit a high of 3,262 points. The previous high was around the 3,247 points. So we got a new year-to-date high on the STI index. So earlier we spoke about this double top formation. You can see these two blue arrow here will be a very strong resistance level. Hence, it's not a surprise when last Wednesday we hit a new year-to-date high. We saw a very big red candle, an engulfing red candle, pushing the market down. So this is still a heavy resistance to watch out for the STI index. And with that being said, the key support level that we are now looking at will be the red color line that you see here, which is the 200 days EMA, 200 days exponential moving average at around the 3,178 points. That will be the key support level. And if we go below this level, then you can see that there might be an uptrend support line connecting the low of December as well as the low in Feb and March of this year, which could provide a very strong support for STI. Should STI come down to this level and a rebound might happen. So for this, I would just like to indicate the current support zone that I'm looking at would be around this level. Okay, so if you combine the top side, this horizontal line over here on the resistance level around the 3,250 points level, and the uptrend line over here, you might see that STI might be going into a formation of an ascending triangle. And at some point of time, a breakout will likely happen. And that is where the next jump in STI would likely happen. But for now, I believe STI will still trade in this ascending triangle into this zone over here. And if you look at the indicators wise, after we hit the 3250 resistance level, MACD in the past 2 trading sessions has been sort of telling us that the uptrend momentum that we observed since the early part of March is subsiding already. The RSI indicator is still healthy at 60 points, so there might still be some kind of a movement around this 3,200 to 3,250 points level. After if let's say it comes down to the 200 days moving average, right? That would be a key level to watch out for us to load up on the STI again. Okay, so next, let me move to the US indices. I'll touch on the Dow Jones Index first. So Dow Jones Index, I believe the key announcement or the key things that we note from last week or the end of the last day of first quarter would be we have a new record close on the Dow Jones Index, meaning this is a all-time high closing for Dow Jones Index, have not happened before, and probably going from here we will have no reference or no key support and resistance level to refer to on the Dow Jones Index if you look at the history. Okay, so let me just reset the chart over here. So where are we likely to go from here? Looking at the indicators, it is still positive. Looking at the MACD indicator, it's telling us that in the last 2 trading sessions, momentum is still accelerating, is still growing, at least on a very slight basis, but it's still positive. On the RSI at 65-point reading, still 5 points away from the resistance level. Hence, this uptrend is still very much intact. This uptrend that we observed since the low of October last year is very much intact. and will likely carry on from here. Of course, we need to look out for the earnings season, the earning reports continue to sustain the valuation that we see right now in the market. But anyway, if let's say we see a retracement back to the 20 days moving average, that is the key level that you'll be watching over here. This green marker over here at 39,199 points. That is something that you want to look at for the Dow Jones Index to get back in on the right for the next quarter at least. Okay. So next, I'll move to the S&P 500. S&P 500, although we may not have a new all-time closing high, but we do have a all-time high during the last Thursday at least, where we hit a high of 5,264 points. That is a new all-time high for the S&P 500. Okay, just let me check my figures. Sorry, 5,261 points, 5,264 points, correct. So that is the new all-time high last Thursday, the last trading day of first quarter, which is 3 points above the 21st March high that we saw. Okay, so same thing here. The MACD indicator still positive reading. RSI is very high to the 70-point overbought mark. Okay, so in a very strong uptrend like this, we usually observe the RSI and the MACD indicator on the top side of things. Hence, if you want to wait for some kind of an oversold signal to come in, it may not even happen. So hence, not only looking at the 20 days moving average would be a good support level to get in on this uptrend, right? You will also want to look at the indicators. If let's say it retraces for the RSI at least, if it retraces to the 50-point neutral mark, that will also be a key indication to that there might be significant pullback already in the index to get back on the uptrend right again. So I'm looking at the 20 days moving average at 5,170 points on the S&P 500 index. On the RSI, I'm looking at least the 50-point level or below the 60-point reading. That would be something that we need to be have our heads up and look at possible entry to the S&P 500. So 5,170 points will be the level to watch out for the S&P 500 to get back on the uptrend right. Lastly, let's look at the Nasdaq Composite Index. So the only index that ended in the red last Thursday, okay, the short-term trading week. So we have seen Nasdaq Composite Index peak around the 21st March period, where it hit a high of 16,538 points, and last Friday we closed at 16,379 points. So there's a bit of pullback there on the Nasdaq Composite Index. On the indicator side, the readings, you can see MACD is negative, RSI is also pull back a little bit or sort of horizontal movement. The reading now is at 59, so just 1 point below the 60-point level. I would say it's still healthy. It still has some signs of positive momentum in the index. So same thing, I'm looking at least at the 20 days moving average at 16,200 points, and that would be a key support level. And if RSI hit the 50-point neutral mark in the RSI, which is something that we saw near the 15th of March, where it goes to 51 points, that would be you can see at this day over here, 15th of March, you have this red candle touching the 20 days moving average. That would be the support level, the first support level that you'll be looking at to get into the Nasdaq Composite Index. So key thing to know, I think as a tech heavy index, all eyes are still on NVIDIA, which has a monster run for the past 1 year. So I think a lot of tech stocks, we are looking very closely to the valuation and what is their forward earnings guidance that will tell us in the next earnings seasons, that will help us to determine whether this incredible run in the tech index and the AI boom will likely to continue. Okay, so that is my take for this week weekly market review. Final words, Gerald.
So I guess going into the second quarter, everyone is just looking out for whether the first rate cut actually does come through in June this year. Quite a number of different things that we'll be looking out for ahead of that, including, say, the inflation data, the jobs data, and also how the companies report their first quarter results as we go into the results season. So those are the things that we'll provide an update on over the next few weeks.
Yes, so we do look forward to Gerald also coming on every Monday to help give us updates on the earnings seasons. And in the meantime, I think I just want to wish everyone a very good start to the second quarter, and hope that you will join us next Monday on our next weekly market review. In the meantime, trade safe, stay safe, and we'll see you again next week. Goodbye.